And I feel like the pendulum's swinging in that favor because mines are looking around. They can't get guys to drill this. And suddenly negotiating power falls in Masterdrilling's favor. And remember, as a 4PL, they're not the ship. They're not the warehouse. They're buying and selling and executing across the supply chain for clients. So it's really a service. They haven't rushed this. This has been a conscious and careful move into this market. I will be watching with interest. Doesn't mean it works. But like I said, he's fired a bullet now. We'll see if he hits something, and if it works, and then he can start firing cannons at it, and it can absolutely be ginormous and massive. So,
hello everyone, welcome back to another FinMeUp episode. We are here today with Keith McLachlan. We all know who he is, we all love his content, we all love his insights, and today we'll be looking at a few companies listed on the JSE, as well as a few companies listed on the Nasdaq and offshore, some of the companies that he likes. So first we'll be looking at the JSE. Firstly, welcome Keith, it's always great having you here. He is also a mentor on the FinMeUp app, so there's been a few posts from him there, so you can check that out. The first company we look at today is a company we both like. It's actually my top holding. I've watched their investor presentation of the last financial year probably like 4 times, read the financial statement 20 times just to make sure I don't miss anything. So keen once again to get your current take, and that is Santova. You know, what's your current view on Santova?
Sure, Higgo, good to be here. Thanks for the nice introduction. So absolutely, I mean, remain holders of Santova in client portfolios and my personal account. Stand back from Santova and have a look at the broader freight industry. And what we've seen is the supply chain disruptions and the excessively high freight rates that have happened over the log jams globally for the last 2 years have eased. We've seen most freight rates, east to west, and likewise major trading routes come down from COVID highs, down about 70, 80, 90%. So there's been quite a sell-off and quite a normalization in those supply chains. Interesting enough, most of them, if you look at where they are now, remain at a premium to pre-COVID levels. So although they've come off the highs, they remain at the premium. So that's the first thing to understand, is the world needed to normalize, and this is actually a good thing. It's one of the arguments for lower inflation globally and things like that. But more importantly, from a Santova perspective, they had absolutely rock star H1 numbers. And the view with FedEx rolling over, freight rates coming and everything in H2, the potential for a global recession and things like that, there's been a bit of pressure on the share price, and there's some question marks around how H2 is stacking up. First thing to realize in Santova is that they are more volume sensitive than they are rate sensitive, given that they earn a spread on the rate. They buy on the one side and sell on the other side, and they earn the spread. Because remember, as a 4PL, they're not the ship. They're not the warehouse. They're buying and selling and executing across the supply chain for clients. So it's really a service. They have far less spot risk. That's the first thing to realize. Second thing is the normalization of supply chains boosts volumes, and that's a good thing in Santova's case. Then consider the fact that they've been putting on new clients in the last 18, 24 months. The growth was organic. It was new clients coming on board, and there's a bedding down process of new clients coming on board that you then get to see annualized volumes growing. A new client just doesn't suddenly trade 100% with you the moment you've onboarded them. It takes a while, and that starts to annualize in. So there should be organic growth. They're not spot dependent, or not as spot dependent as traditional, 1, 2, and 3 PLs, given that they're a 4PL. And then consider that they earn predominantly hard currency revenues, and the rand is materially weaker on average than it was. So we're actually looking it was tough to call how it was going to be, but as the second half has played out, we're getting increasingly confident that there should be good numbers coming out. This is a world-class company. It's compounding. It's in the right places, doing the right things with a great management team who's opened up the right trade routes. And it's all sitting on a 5 times multiple. It's really a global business. It just happens to be listed on the JSE. 5 times multiple. We like it at these levels. We liked it before. We like it now. We don't see any of that changing. So looking for good numbers coming out.
What do you think of the A-Link acquisition? So somewhere, I don't know where I saw it, but somewhere in the comments I saw that they think that the US segment can be one of the biggest earnings contributor. And also on client base, they also highlighted that, that it's a new clients acquisition that really boosts the revenue and earnings, and not necessarily the high rates, although that has an impact, but a small impact on the new clients. But what's your take on the A-Link?
So first of all, you need to understand that the American logistics sector is surprisingly heavily regulated. That creates large barriers to entry, and it makes it very difficult to break into the market. So beyond acquisition synergies, et cetera, what this does is it gives them access to one of the largest logistics sectors in the world that they previously did not have access to. They could send product to, but really as a global supply chain manager, you want to earn on both sides of the transaction. You want your offices not just helping client product go in, but you want an office in the receiving ports, bringing that product in, so you earn on both sides of the transaction. You could distribute it domestically. And America being very heavily regulated with lots of rules and lots of compliance, this gives them a beachhead that is hard to replicate, and hard to replicate at a reasonable price, which they did do, and they made quite a reasonably priced acquisition. First thing. Second thing is there's not a huge amount of capital at risk here. Glenn Gerber, as a CEO, has been very good in firing bullets before he fires cannons. And you allocate small amounts of capital into things that make sense, that if they work have large blue sky growth potential, but if they don't work, you stand to lose very little. This is not betting a large amount of the group balance sheet. It is yet it has large potential as one of the largest logistics markets in the world. If they get this right, the application of a small amount further capital, and you could see in 5 to 10 years' time, this absolutely being the largest segment in the group. So I think A-Link, and Glenn for a number of years has been talking to me about going into America, looking at the market. They've been walking the streets, doing the hard yards, understanding the market, understanding players, finding something that fits at a reasonable price with the right culture. A 4PL business is not just a tech business, it's really a service business as well. You've got to have the right people with the right culture that integrates with the group. And they haven't rushed this. This has been a conscious and careful move into this market. I will be watching with interest. Doesn't mean it works, but like I said, he's fired a bullet now. We'll see if he hits something, and if it works, and then he can start firing cannons at it, and it can absolutely be ginormous and massive. So optimistic on it. Once again, I think Glenn and the team have been executing well, and I'm excited to watch how that plays out.
Greatly summed up. What I really like about them is, it is on a very attractive valuation. They have a great track record of revenue growth, earnings growth, and now they are buying back shares quite heavily, consistently. So that also builds the book value per share as well as, at the end of the day, the earnings will look better, because there's less shares outstanding. And, it is an international player. They've close to 80% of the revenue is offshore. So, who knows? We might even see a foreign listing in a few years' time. That's just a sky-high guess, but, that would be great to see. But, yeah, I love Santova. We'll continue to research. We'll continue to view them closely. I think one thing, while they could also be a bit underpriced, is it is quite difficult to understand what they do, and they don't necessarily specify a lot on their product, as well as, what percentage of their profits are recurring. I know that's not the business model, but anything relating to the product, I think if they explain that a bit better or make it more open, we could see a PE a bit higher. But I love the company. The second company that I know you also like, that I also own, Masterdrilling, something completely different, but also a large chunk of their revenue comes from offshore. But I'll leave this one to you. What do you think of Masterdrilling?
So remain a fan of Masterdrilling. I mean, it's a world-class company, not just in terms of the size of its fleet and what it offers. It's actually a world-class company in terms of technology as well. And when we're talking in a niche that is still increasingly relevant as minerals get deeper in the world. We need drilling services in this space more, not less. So they got great tailwinds. They position number one in the world. Great geographic reach. Fantastic management team that remains deeply invested. None of these things have changed. What we are looking for, though, is the weakness in the rand should come through in terms of rand translated profits and create some uplift. They had a very good record order book at the end of last period. That logically gets booked as revenue as we go forward, and we'll be looking for a pretty good order book going forward as well. Still on a low single-digit multiple for no apparent reason. This is a great business. There's not a huge amount to update. We're looking for fresh numbers and trading profits out soon, trading update out soon. But yeah, the commodity space is perhaps some of the tailwinds have come off in the short term. In the long term, there is not enough supply on planet Earth for all the demands on commodities. So longer term, I'm still optimistic in terms of mining. It is absolutely relevant, and the suppliers into it, particularly as mines get deeper, minerals get scarcer, and safety measures become more important from a social perspective. Non-blasting services in this space, especially automated non-blasting services, start to become more relevant, and really that is 100% where Masterdrilling plays. So still bullish on the stock, looking for fresh numbers, think they should be good. This as a company with a fair amount of operating leverage, though it can be quite volatile in terms of bottom line. Longer term, extremely comfortable with it.
Yeah, I know that, okay, so their PE is around 4, which is crazy. The previous year they had a really good year, and when the management spoke about the prospects, they were also really optimistic of this year that we are in, but also going forward. And if you look at the order backlog, it's huge. I mean, they don't have a problem getting clients, getting work. And at the end of the day, those that revenue, the projects, that leads to profits. Oh. And
so it's also quite important pointing out that in order to build these drilling fleets and get them and operate them, it takes a long time. So when there's a shortage in the market, what you'll see is the order book topping out. They won't necessarily grow the order book, but they'll start to drive the pricing per machine. And I feel like the pendulum's swinging in that favor, because mines are looking around, they can't get guys to drill this, and suddenly negotiating power falls in Masterdrilling's favor, and they go, right, if you want our machine, you have to beat these guys who also want it. And the pricing power moves in their favor. And I feel like as utilization ticks up, the order book ticks up, what you'll start to see is a flat line in terms of that, but an uplift in terms of what they call operating revenue per rig, OPAR. And that has a huge leveraged effect. Any $1 you rent out these machines for, in surplus of what you were renting it out for, drops straight to the bottom line. And that's a huge leverage effect. I feel like the pendulum swinging in their favor at this point in the cycle.
Definitely, they've got a massive competitive advantage as well. Building what the infrastructure that they already have is not going to be easy, and the expertise, the clients, their everything is in favor. But what do you want the management to do? Because the P is at 4. It's been undervalued for a very long time. There's not really buybacks that I'm aware of. The dividend, there is a dividend, but it's not huge. So would you like to see, just hope the market reevaluates them, or would you like to see a big dividend or share buybacks? What would you like to see as a shareholder?
So the founder, Donnie Pretorius, is still the major shareholder and the CEO. Fantastically deeply involved in the business. The original rig that he bought that he rented out for the first contract and used is still in the fleet that they're still running now. But the trade-off, the challenge is where you have such a large shareholding held by the CEO and there is a large holding by the remaining management, you have low liquidity in the market. I think a small amount of share buybacks with surplus capital might be nice and will be very earnings enhancing at a 4x multiple, but you start running into liquidity problems. I think the starting point is because in order to build out the fleet and a range of things they were doing, they brought on a little bit of debt. They can de-gear that very quickly, and they've been doing that. The likelihood with the latest set of results, they have very little debt on. My advice to the management team was de-gear, get into net cash position. And then I think what they need to apply that capital to, beyond a trickle of small amounts of earnings enhancing share buybacks, is start putting out a reasonable dividend, but focus the surplus cash on building out R&D. They've got superb RP in this business. They're currently leading from the front in terms of the industry, and the industry's tailwinds are working in their favor in terms of deeper level mining, greater reliance on drilling, non-blasting techniques, and automation. There is still a large amount of drilling within mines and across industries that they don't yet capture. Like, for example, their main shaft borer technology, build that out, get that right. This becomes the RP of the future that they are then not just leading from the front, they're in an entirely different stratosphere versus all the other players because they own the RP. This is what the next 10, 20, 30 years of growth is going to come from. So a little bit of dividends, a little bit of buybacks, just logical capital allocation, de-gear the balance sheet, move into net cash, but R&D can start to kick up. And this will be building the business, the mining business, the drilling business of the future.
Interesting. Moving on to another company that you cover, that I'm not exactly sure how you pronounce, but I know what it is, and that is Stor-age or Stor-age. Not exactly sure which one it is. It's obviously, there's a lot of people who've got more products and goods and stuff you bought on Take Lot and Wonder Only that you don't really use, or your kids' books when they were little. We all have things that we need to store, and sometimes we need to store that somewhere. So, I know from previous interviews and readings of your insights, you like storage. What's your current take on them?
So first of all, you've got to understand the self-storage market. And the self-storage market has a number of very attractive attributes. First of all, it's quite defensive. And it's quite defensive in the fact that there's three major pools of consumers that use, or customers that use self-storage. The first one is businesses either growing or shrinking, and SMEs, and so you've got a business aspect that uses this as cheap, easy surplus storage that don't necessarily want a 20-year warehouse or DCF. It's just a couple of rooms, this and that. They stash it in there. They've shrunk the office, or they're growing the office, and that's about a third of the demand. That's always this churn that's going through, and that's necessary. And you know what? Even though they might pay a higher price per square meter, it is a lower nominal fee than renting an entire warehouse where they're not going to use 90% of the warehouse, and they don't want that anyway. So that carries on happening. Then you've got what they call there's a base underlying of I'm trying to remember the term. It's effectively life-changing events. You get divorced, and instead of living together, two people have to live separately. Someone moves out in between houses, needs to put their surplus goods somewhere and stores it in these places. Maybe people get married and you're taking two households and sticking them together. You've got surplus amount. People are downsizing, upsizing. There's all these churns of life-changing events that, by the way, doesn't matter in the economic cycle. These things are happening. And those people, once again, are less price sensitive. And then, like, the remaining are just guys that just want, they don't necessarily want to upscale or downscale. They've got surplus goods. I know people that store wine collections. I know people that store whiskey collections in self-storage. It's not something they're going to access every day. They just put it off somewhere and it works, and the surplus goods sit there. So the underlying fundamentals of the consumer, the users of self-storage, don't track economic cycles. They're very defensive. Then there's further characteristics that make the self-storage model attractive. Unlike most rentals, this one is an asset-backed rental. If you don't pay your rent and you go absolutely AWOL and self-storage company can't find you, they can always open your self-storage unit and sell the physical goods you have in it to reclaim some of the bad debts owed to them. That's very different to shopping centers, very different to office, very different to residential, very different to a lot of things. So there's an asset-backed element that offsets some of the potential bad debt from the churn. And then the remaining element is very, very attractive in highly inflationary environments. So a lot of property companies will stand up and talk about rentals, and they will brag about having a weighted average lease expiry term of 10 years or 15 years or 7 years. The problem there is if you sign those leases in low inflationary environment, you probably have low escalations and you've mispriced your lease, and now you're carrying that mispriced lease for a number of years that you would love to reprice. Self-storage is month-by-month rentals. That churn allows them to reprice these leases. They can push through inflationary escalations on a month-by-month basis, and if a person doesn't like it and moves out, they can bring someone else in. And they'll bring them in, not at historical 5 years ago lease rates, but at modern-day, current, like inflation-adjusted lease rentals. So short-term rentals. And there's other markets that have this characteristic, like hotels, but hotels have their own cyclicality because of the ultimate consumer. Self-storage doesn't. So they're wonderfully positioned for the current environment. Then shifting directly onto Stor-age, they still have a low LTV. They're absolutely dominant in South Africa. They've got about 40% of their balance sheet in the UK. All of these things are working. They're delivering the above inflation, or at least inflation tracking returns in terms of rental growth. And the share price is currently trading below tangible net asset value. Yet you've got an internal manco, internal sales force that manages all of this, that's got an equity-like component, because they can sweat these properties, they can run them, and you're capturing this. You're not outsourcing it to an external manco. So still, I don't think storage is the business that will be shooting the lights out in terms of don't be looking for 30, 40, 50% returns year on year. But this is a business where you're buying it below tangible value with an internal manco that's got equity-like characteristics in a deeply defensive subsector where they're dominant locally. They've got hard currency exposure in the UK, and they've got an undergeared, if not defensive, balance sheet with a forward yield of 8.5%, approaching 9%. This is a company that you can slot in your allocation for your core defensive yield enhancing part of the portfolio and forget about it. They are delivering the goods. I remain a big fan.
Just quickly, I started looking into Equites. Do you follow them at all?
I do, but they're a good example of a business that has extremely long-term rentals. And the reality of warehouses and DCFs is that at the end of the lease term, the bargaining power is upon the bargaining power shifts to the customer, because the reality is a warehouse can be built next door and it doesn't really matter. So in the UK, because land and access to certain roads is a little bit more restricted, don't forget the UK, England is ultimately an island, and hence one of your scarce resources is land. There are some more barriers to entry, but those come out in pricing. And you can see that the price per square meter in warehouse and DCF is very expensive. In South Africa, for example, in Centurion and the like, where a lot of the DCFs and Equites exposure is, really, there's a lot of land. You can just build it next door. So Equitas is a good example of a company that is in the right space, and they're going to do well. But as that weighted average lease term expires, I think their rental reversions are going to start falling off cliffs. We were probably about 5, 6, 7 years away from that starting to become apparent. And management's done a good job of deferring that out. But it is not one of the ones I'm a fan of. If you're looking for guys that are operating in this space and you're willing to go global, I'd much rather look at Segro. Segro is effectively who Equitas modeled themselves on and is miles ahead. It's a discount to book value, based mostly in the UK and Europe in high densification areas. They specialize in last mile. Last mile DCFs are far more valuable because when you're sitting in town, when you're sitting in central London, well, land then is in fact scarce because it's built up, as opposed, once again, in areas where, we can always just build a DCF next door, down the road, further somewhere. So Equitas, I'm less of a fan. And in fact, if you have a look at management dealings, they've been selling large pockets of shares. So I think they're voting with their money to agree with me. If I could stand corrected on that, but I think they have been selling large pockets of shares.
Okay, quite interesting. We can double check that. It's always good to see when directors are buying. They can sell for many reasons, but it's definitely a good thing when they are buying. Let's get to Spur. This is also a company that you follow. The odd burger at Rockamama's or ribs and chips at Spur is always nice, but they delivered quite solid results. What's your take on Spur?
So I think they're in the right place. They've got a new management team that's doing the right things. I've been watching, and they've been introducing the correct angles. They've been right-sizing elements of the business, but they've obviously traded through a really messy, tough period where with lockdowns and all sorts of other elements, and you could see that they've cut out a lot of costs at the center. They're less dependent on supply chain elements that Famous Brands, for example, is, where they're getting hit with load shedding, getting hit with fuel, getting hit with all the mess. Spur's a far cleaner franchisor model, and they've got a net cash balance sheet as opposed to a net debt balance sheet of Famous Brands. So I think Spur's in the right place. I think the new management team is starting to do the right things and is starting to come through in the numbers, and their balance sheet and their valuation is far more attractive than Famous Brands. So I do think Spur's one we like. It is a smaller company. I wouldn't put it in all portfolios. It's very mandate specific, but it's doing the right things. And ironically, load shedding might push more volume their way. If you can't cook at home, what are your alternatives? And especially if you've got kids, Spur's perfectly positioned for that. Their use of virtual kitchens also leverages the trading density at the store level, leverages their footprint, and pushes incremental volume through that helps those people who don't have kids, who just want to dine at home on Uber Eats and Mr. Delivery and the like. So I like Spur. I think it's in the right space. They're doing the right things.
And then the last one is a company that you're excited on, but that most people will think it's boring, is Momentum Metropolitan. Why did you choose Momentum Metropolitan?
So the life insurers have come out of a period as an industry. The life insurers have come out of a period where the pandemic drove excess mortalities that negatively impacted them, on the one hand. On the other hand, it also proved the value of life insurance. So, and funeral policies and like medical aids, and it's proven the value of those. Momentum Metropolitan, first of all, gets to gain the tailwinds that the whole industry, Sanlam, Discovery, all these guys get as the excess mortalities roll over. We come out the other side. And in fact, there's a strong rebound in profits. We've seen this with Momentum Metropolitan's latest trading update. In a couple of days' time, they will have more detailed numbers out and expect those to be positive. But why specifically Momentum Metropolitan? Well, first of all, for a number of reasons relative to the other guys. They've got a new management team that's driving a turnaround in the business. So there's not just a sector level recovery from the pandemic that's happening. They've actually cleaned up the business in the background. They should come out of this better than they went into this. Management has done the right things. So that's the first thing to think. Second thing is Momentum Metropolitan has less exposure to short term. And the short term industry is still going through pain. But unrelated to the pandemic, going through pain because of load shedding, riots, floods, all business interruption, all those other issues that are, especially load shedding is still continuing and the potential for a grid shutdown and excess driving claims from load shedding creating chaos in traffic. The short-term industry isn't necessarily where you want to be at this point because they're still working with excess risk that is coming through in excess claims and they're trying to sort out their books. Momentum Metropolitan has far less exposure in this area. It's a far purer life insurance wealth player. They also don't have the problems that Discovery has in terms of desperately trying to go offshore, desperately trying to fund a loss-making bank that's creating drag on the business. And like I said, Sanlam has, for example, a large exposure to the short-term industry via their holding in Santam. Then Momentum Metropolitan, when you look at their share price as a discount to their embedded value, all the life insurance, all the insurer guys, they calculate something called embedded value. And embedded value is basically they are building a DCF and they're valuing their own business. They're giving you a valuation. They're doing all the heavy lifting for you, which is really, really wonderful, especially when you work through their assumptions, and they do disclose their assumptions in this part. What it does do, if their assumptions are conservative and one can build a lot of confidence in the embedded value, it gives you an indicator of potential upside. Now, most of the insurers are trading at a discount to embedded value at this point. The largest discount, ignoring clientele, that is a small, much less liquid stock than Momentum Metropolitan, and some of their discount is just based on the fact that you can't buy a script. There's no liquidity in the script, and it's not really a good comparison. But of the major guys, Momentum Metropolitan is trading at probably about a 40% discount to their current embedded value. They traditionally traded a bit of a discount. It's closer to 15 to 18%. So there is a lot of free upside left here. And the final thing that they're doing that the other guys aren't doing is they've got surplus capital, and because they're trading at such a long discount to embedded value, they're buying back shares. The math of spending R1 and buying back your own shares at 40% discount, the math is so attractive, it creates huge accretion going forward. So we expect the share price to capture all the tailwinds that the life insurers have, but undiluted by short-term insurance drag, undiluted by a loss-making bank drag. They're capturing management turnarounds that the market hasn't priced in, capturing share buybacks at a discount, and yet the share price itself is cheaper than all the other life insurers. And it doesn't hurt that you're picking up a really attractive dividend yield, 5-6% at this point as an underpin in this place. So it is, and I could see your eyes glazing over in terms of life insurance, Higgo. It is not an exciting industry, but the math is so attractive with Momentum Metropolitan. It's very much a high conviction play for the next couple of years as this unwinds.
Very interesting, although boring, interesting. Boring company, but interesting.
Making money is not boring.
That is very true. It is not, especially if it's easy with boring companies. Anyway, getting to your US stock picks. The first US stock pick, I don't even know how to spell or pronounce or what they do. So please introduce that first one and what they do and also why you like them.